Well, for some more analysis, let's bring in Economides. He's an economics professor at New York University's Stern School of Business. He joins us via Skype from San Francisco. Welcome back to the show.
Thank you, Ursula.
So as we heard, they're citing supply chain disruptions, inflation, worker shortages, COVID-related shutdowns. The IMF has lowered its global growth forecast. What's your take on what the IMF laid out today?
Well, I think they're being cautious. They see the inflation, they see the supply chain restrictions, and they also see the disruptions, and they also see the Federal Reserve for the first time in many years trying to increase interest rates. So all these go in the same direction, saying growth is going to be lower, and to some extent this has been reflected in the valuations of the stock market in the last couple of weeks.
So then as we see these growth estimates then going down from 5% to 4.4%, put that into terms for what that means for a country's GDPs and what that means for the average resident or consumer out there.
Well, it means trillions of dollars less GDP, less production, and it means a slower expansion of the economy. We're not in a recession, we're not seeing a reduction of activity, but we see a slower expansion of the activity, and of course that matters to human beings because we get paid according to how well the economy does.
And obviously both China and the US having their growth estimates revised downward. Talk about the headwinds that the two biggest economies are facing that justified that revision.
There are issues of COVID in both countries. The countries have different strategies in dealing with COVID. The US is much more open. China has severe restrictions when COVID shows up. That means that what happens is more likely to have more cases in the United States and more likely to have more supply chain restrictions and reductions and disruptions in China. But ultimately, in both circumstances, there is going to be less production, less employment, less growth.
And obviously people seeing prices going up all around them. What is the IMF saying about inflation? And what does the IMF think should be done about global inflation?
Well, I don't think the IMF is in position to actually tell the countries what to do. But what we have been seeing in the United States, and to a significant extent, we're seeing something similar in China and the European Central Bank, is an attempt to reduce inflation through an increase in interest rates. Now, this has obviously some adverse effects. Money is more scarce, money is more expensive, so that would tend to reduce growth as well. People would have a harder time borrowing, or they have to borrow at a higher price, at a higher interest rate. So these are problems that are understood. And the Fed and the European Central Bank and China understands these issues, but the prospect of runaway inflation, that there is going to be an inflationary cycle that would last many years, that prospect is so adverse, so dangerous, that the Fed is going to be willing to sacrifice some of the growth to make sure that inflation is tamed.
And obviously a lot of uncertainty, not just around the course that COVID may take going forward. You also have things like climate-related disasters, rising political tensions, particularly around Ukraine. All these things also contributed to the IMF's findings. How do some of these less predictable issues shape growth prospects?
Well, the virus is very unpredictable. I mean, we know that there is the Omicron variant, which is much more communicative, but it's on the average less severe. But on the other hand, if you have 5 times more cases and it's a bit less severe, but not extremely less severe, then the hospital system can easily be overwhelmed. Now, on top of it, you have this crisis, this geopolitical crisis in Russia, between Russia and Ukraine, and more generally between Russia and NATO and the United States. Now, this is a hard, almost impossible issue to predict how it's going to end up. But even if nothing really happens in the end and there is no invasion and so on, it has an adverse psychological effect in the financial markets because people get reminded that things are not stable, things are not normal, but there is a real possibility that things can go haywire.
Indeed. Well, we do appreciate your insights, as always. Nicholas Economides there, economics professor at New York University's Stern School of Business.